Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, November 28th, 5:12 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we're in a bear market rally off the lows for about the last month. That got a little bit weaker today with a changing character on the very short term. We'll take a look at that when we go through the charts. But reflecting over here on the trend gauge, leaders still holding up fine. Three of the 21 broke below the 21-day exponential moving average today. So that's really not bad considering how red the indexes were. As far as the five major indexes go versus their short-term 21-day exponential moving average, all five still above, so we're bullish there. All five above their medium-term 50-day moving average, bullish there. Only two of the five above their long-term 200-day moving average. So still on bearish there. What happened today? Not a good day. Indexes give back all of the Thanksgiving week gains. We were weak out of the gate. Bullard started around noontime talking more hawkish, basically saying the market is discounting that we or is ignoring the fact that it's very likely that we will continue to raise rates throughout 2023. The market didn't like that. We trended lower into the close, and the result's not pretty. G6, this is our 6 ETF growth composite, down 2.12%. S&P 500 down 1.54%, NASDAQ 100 down 1.5%, Dow down 1.5%, mid caps down 1.9%, Russell 2000 small caps down 2.05%, Global Diversified 60/40 stock and bond down to 0.94%, in-house our flagship GROTECTION portfolio down 1.43%. We'll go through the tail of the tape. We'll look at charts of interest, and I'll show how to calculate ATR because it's it feeds into an educational segment tonight about what questions to ask when you're deciding to trim your portfolio. So let's get right into it. First off, let's talk about what we do here at Revere. We are a fiduciary fee-only, completely transparent, registered investment advisor. And we're trend followers. We are in the market when the market is going higher. We protect the market when the market is going lower. And various shades of gray in there dictate, based on what's going on with the trend gauge and leading stocks, how exposed we are to the market. You take a look here. This is a weekly chart of the S&P 500. Back last October, things trending just fine above the key moving averages. But when we got into the beginning of this year, things started to roll over, and we started to lighten up. Some stops started getting hit. But if we're really going to start going lower, you're going to see the slopes of the lines of the short term and the medium term moving average roll over. And we started to see that in January. And then we broke below the long term black line. That's the 200-day moving average. And history tells us from all of our research that that is the sign to get the heck out of the way, because all of these 13 bear markets going back to 1970 all occurred beneath the 200-day moving average. Now, just because you break below the 200 doesn't mean it's going to be a bear. Sometimes you just bang around under there for a couple of weeks, get back above. We tried to do that, but ultimately we rolled over in a major way on April 21st, and we went lower in 3 waves down. Ended up being down 27.5% for the year. But we've got rules at Revere to keep us away from these severe sell-offs. And if you're and then we have rules to get back in when the market starts cooperating. If you're interested in this approach, give us a shout. Email me, don@revereasset.com, or email Dan, my partner, Dan Stewart, dan@revereasset.com. We'll get you pointed in the right direction, answer any questions you have, or you can phone 855-REAL-WEALTH. That's 855-732-5932. So let's get into it here. Let's go to the 60-minute chart. We've been focusing on this for a while. And notice, I always say, comments, questions, concern, give us your feedback. Notice my cursor is larger and it's pink today, and that's because of some feedback that we received that it was hard to see the cursor. My cursor is typically white, and with a white background, not always easy to follow, but it should be easy to follow with this lovely hot pink color that I've converted it to. So here on a 60-minute chart, we talked for a while about this 3,900 area, got back above it on this gap up on CPI report on 11/10. And then that continued a rally that happened from this big shakeout on October 13th, right? So got about, you can see 3,900 acting as resistance here, couldn't get back above it, bounced below, gapped above it here, continued higher, and then we started pulling back from this initial move up, and 3,950 was the area where we started pulling back to, this whole area here, and then we broke below it on a bad news day, but the 3,900 held. So this is 3,900 going from resistance to support on the back test. That's good stuff. Then we get back above this 3,950 level, which served as support during these pullbacks after the initial run after the CPI data. So we got back above it, back tested a little bit, stayed above it, and then tried to make higher highs here. And we did briefly make higher highs late last week, but then the gap down this morning, pulling back, we bounced. What was our low today? 3,955. So for now, and I've been talking about this in the tail of the tape, this 3,950 level has held. If that doesn't hold, the next level we look down to is 3,900. 3,950 critical, 3,900 even more critical. And it's even more critical because now we've got the 21-day exponential moving average has moved above that 3,900 level. It's now at 3,917. It'll be above 3,920 tomorrow. On here, this purple line is the 150-day moving average, but let me change that back to the one I usually use, the 8 EMA, because we're going to be looking at that as a key off of the short-term, ultra short-term changing character, which you can see here. This is our first close below the 8 EMA since that move up on 11/10 when we had the big CPI gap up. So minor change in character. We key more off of the 21, but we are mindful when we're below the 8. If we continue lower and the 8 starts to roll lower, that's telling us settle down on adding any new positions, because for now, basically we ran into the declining 200-day moving average, got within a couple, less than 1% of it, and the market failed today in that area. Is it a one-day failure? Use the old fool me once, shame on you, fool me twice, shame on me rule. One close below this doesn't mean a trend. Two does mean a trend. 2 or more means we really better start paying attention. Then we look at the 21, and then if that breaks, we look at the 50. We just start backtracking after the progress that's been made, because all of last week's progress basically got undone in one day now, and that's very clearly not what we're looking for if we're a bull. So we closed at 39.64 today. The Friday before Thanksgiving week, we closed at 39.65. So everything last week, all the gains given up in one day. We've also, on all 5 of the indexes, from various conditions of overbought, have had this hook down in stochastics now. Now, we also had it back here, and it was temporary. We flatlined a couple of times last week, but this is a pretty severe hook down on the action today, and we're threatening with breaking below the moving average and then below the 80 level. So we definitely are paying more attention and have our stops tightened up, and we did take some positions off today. This is not what we wanted to see. We talked about some of the warning signs last week because of it, with various indicators being either overbought or oversold and stretched, and the market can only stay stretched for too long. Ideally, we would have liked to see this go sideways, and that's really what we want to see tomorrow, is maybe an inside day. And allow the indicators to maybe come down a little bit and then circle back and make another try at the 200-day moving average, because the alternative is lower prices, a break of the 21-day, and we've got Powell speaking at 1:30 Eastern time with a Q&A on Wednesday, and there's going to be fireworks on that. So we kind of came into the week with the plan to already be trimming back. The market made it pretty clear which of our positions we should have trimmed back today, and we'll go through that when we go through the tail of the tape. So there's your S&P 500. Next up, NASDAQ 100. Weakest of the 5 indexes, below the ADMA, sitting 0.6% above the 21-day exponential moving average, and it also failed at that 286 key fib level. I didn't specifically mention that, I don't think, on the S&P 500, but that 4,007 big fib level that we got above and stayed above for 2 days, we failed below that today. So that's another change in character and another negative for the market. Let's move on to the Dow Jones Industrial Average. This is the strongest on the indexes, closed basically right on, well, 0.1% below the 8 EMA. So really for now, that's a failed breakout above 34,000. We had 3 closes above it, all undone in 1 day. Failed break above 3,400. Maybe it's going to be a normal pullback. In fact, you can see we trended above the ADMA for quite a while here, 5-6 weeks. This may be just a normal pullback. And then we're going to go through some questions later to ask whether or not we can decide if a pullback in a stock or in an index is normal. After we go through the major indexes, we'll take a look at those questions. Next up, the second strongest of the indexes has been mid caps. The S&P 400 also closed below the 8-day moving average today, and it looks like it's trying to roll over, coming into only 8 points above really the 21 and the 200 there, that are sitting right around between 451, 452. So that's a big area of support that we'll be looking for tomorrow. If we break below that, very clearly change in character, because that'll be a failed breakout above the 200-day for mid caps. Let's go to small caps, which struggled to get above the 200. Single close above, break below, single close above, back below, closed right on it. Basically Friday, 0.1% above, failed today, broke below the 8, and in fact closed 0.1% below the 21. So that is not a good sign for small caps here. And note the relative strength or lack thereof on small caps over the past 3 weeks. And growth small has been worse than value small, definitely as a growth shop. And knowing that growth stocks strongly lead the market up and down is more cause for concern, which is why we haven't been piling much into growth stocks. Anything that we've taken has been a quarter size, at the most a half size, and keeping a close eye on all of our stops. So there's IWM. Let's look at the dollar, and this was part of the problem today. The dollar trended higher all day. Let's take a look at SH. This is the inverse of the S&P 500. Basically looks exactly the same. Or for a shot at the inverse on the 5-minute chart, just bring up the S&P 500. You can see it trended lower. Here's the volatility where Bullard spoke today, and then trend down into the close before a little bounce off of that 39.55-ish area. That really needs to hold on any further pullbacks, or worst case below that, we've got 39.20 tomorrow with the 21-day, and then the 3900 area that I mentioned. So that's the dollar. Let's look at the VIX. We mentioned that the VIX has been working in our favor, but was very oversold and stretched below the moving averages, and you got a big bounce in the VIX today. Also came down to this 20 area, which I noted on Friday was where we stopped going down in August, where we stopped going down in April on the VIX, which coincided with tops in the S&P on both time periods. And it's looking at like the same setup right now. Bounce into the 8, we're right at the 8, we'll be monitoring. This is doing basically the complete inverse from a moving average standpoint that the S&P 500 is doing. Let's take a look at bonds, TLT here. You can see bonds basically in a holding pattern. Bonds were higher early in the day. They pulled back as the day went along, just going sideways there. Let's take a look at the yield. Here's the 10-year. The yield on the 10-year kind of holding tight, up a little bit today. The yield on the 30-year TYX closed at the top of the range, made a lower low before bouncing. How about junk bonds, JNK? Junk bonds down 1% today, also breaking below their ADMA. So basically they're acting the same as the S&P 500 is acting. How about gold? How'd that do today? With a strong dollar, you would expect gold to be down, and it was. In fact, below the ADMA. Gold stocks got hit too today, and we got stopped out in our GDX position. Let's take a look at Bitcoin. the Bitcoin futures. Let's look at a 60-minute chart here. Just kind of going sideways here around this 10 area. This roughly equates to the 16,000 level in Bitcoin. So those are the major indexes and that we want to take a look at. Let's get kicked off now on the tail of the tape. So bear market rally. G6 and the indexes both reversed lower, so that's a negative today. So technicals positive for a while, got into overbought / oversold depending on what we're talking about. NASI is extended, and these are starting to unwind, and that's resulting, it's staying in sync with a move lower in the indexes that we saw today. Put call at a 1.05, VIX bounced up to 22.2. Fear and greed down to 59, still operating under the bull case, but we really need to hold the 21-day moving average and those other key areas that I mentioned. The gap down this morning was initially blamed for, and probably was blamed because of the massive protests in China on COVID lockdowns. That's was the explanation for oil being lower, gapping down about 3%. Then the UAE came out and said they're cutting their exports to oil, and the price of oil, USO, recovered on the day to close basically flat. But oil stocks didn't. They ended up, they lagged all day, a little bit of a bounce, but then rolled over later in the day. So our day count up 3 out of the last 5 to down 1. Expectations were positive as long as we're over 39.50. We had a negative day, but 39.50 did hold. So the bulls are holding on to that. As far as key levels go, as I mentioned, both the S&P and the NASDAQ 100 broke below these key fib levels, gapped below it, couldn't get back above it. The intraday action I mentioned, we set a high within the first 5 minutes. That's never good, especially when you're gapping down. And then bullard with the noon volatility, and then the trend down day to 39.56 where we bounced. The only thing green on the day was the dollar. 11 out of 11 sectors down. Staples, XLY, because Tesla finished barely green today. And also Amazon was up because apparently Christmas sales over the Thanksgiving holiday were better than expected. So Amazon was up also. That's why consumer discretionary outperformed and healthcare outperformed. Biotech started out strong but ended weak. Bonds started out strong but faded. Big to the downside, oils, solar, semiconductors, and gold stocks. We'll take a look at this focus list here. This is a combination of things I'm looking at, and then from our morning meeting, everybody gives names that they're focused on, and that's gives a good list of leaders to focus on. And we'll take a look at those charts momentarily. So as far as we did the portfolio in-house, S&P 500 SPXL, this is our leveraged ETF that we're in. We trimmed a quarter of that to lock in a gain as we started to reverse and broke back below that 4,007 level. We also sold we sold half of our Mobileye as that broke below the 28 area, and we sold our ETFs, the oil ETF and the gold ETF. We'll take a look at those charts momentarily. But the bottom line, a trend up day for the dollar and a trend down day for stocks. Giving up all the gains from last week. Very unfortunate. Broke back below this key 4,007 fib level, and the next level down held 39.50 to 39.60, we'll call it. But then we're coming into the declining 150-day moving average and the rising 21-day moving average. So lots of levels of support here going down to 3,900, which should hasten or should provide support to falling prices. But if the market wants to sell off, it can slice right through them if it wants to. My expectation would be for a neutral day tomorrow, waiting on Powell's speech on Wednesday, which is going to be a lot of attention paid to that. And then we'll see how the markets shake out from there. But if it's any indication of the way he talked at the press conference on the last FOMC meeting, and basically Bullard echoing what he's saying, it's not even time to start thinking about pausing rates, the market could be in for some hurt, and we'll be prepared for that either way. So let's get those questions I want to bring in, and then we'll go through the buy sell decisions that we had today. So when the market's weakening and you're deciding what positions you want to trim, this is kind of a thought process that I go through when we're looking for always, is there a change in character in the market at all? And by time frame, on the ultra short time frame, the ADMA, there was today. We were trending nicely above it. We broke it, and the fact that we gave up a week of gains in a day is a change in character. How did leading stocks do for the most part? Okay, still plenty above the 21-day moving average, but will they hold up? We don't know. Was there a change in growth versus value? Well, value has been outperforming growth lately. It was kind of mixed today as far as growth and value. No real major standout either way. What about sectors? Solar has been leading, and solar did not have a good day today, down 3.5%. Semiconductors also leading recently, and they had a bad day today. So a little bit of a change in good sectors showing poor action. And then about the individual stock, was there a change in character in them, is definitely something that you want to consider relative to what it's done recently. How was volume? How was volatility? Is the stock lagging versus the S&P since we bought it? Every time I buy a stock, I write down where the S&P was at. I want to make sure if a stock's going up that it's going up at least as much as the S&P, and preferably twice as much as the S&P, because otherwise we're not really in a leader and we're wasting valuable capital that could be fed into a stronger stock. And then finally, when things start to pull back, you got to look at your cost basis right away. You have to protect your cost basis and your stop. We've been running some numbers and trying to update, make sure that the optimal stop that we're using is valid. We'll talk about that more later in the week or a little bit next week when some of our final research comes in for that. So these are questions to decide when you're looking at what positions to trim. So let's go over what we sold today and what the decision for making those sales were. So first of all, I mentioned the S&P 500. We basically had 4 buys on SPXL, all between 39.50 and 39.75. So when we broke below 4,007 today and the ADMA, the most recent buy, we locked in a small profit on that. So we've got 3 of the buys left there, and if we get below 39.50, all 3 of those will be underwater. Right now we're on a combination of basically flat to a little bit positive on the 3 of them. So that was the first question. Why did we sell it? Minor change in character. Break below 4,007 and below the ADMA called for blowing out some of that SPXL. Mobileye, the third buy on this had been, anytime we got, really the third buy on this was in the high 29s. And anytime we would get back to even on it, we were pretty much underwater immediately on it, but it was only a 1% position. So we never reached the fact that we were down 10%, which when we buy a small partial buy like that, we use 0.11% is the new number of overall loss to the portfolio. We don't want to exceed that. And when things are pulling back and a change in character, why wait for, we don't necessarily have to wait for our stop to get hit. If we want to proactively reduce size, we can reduce size. And that's why we sold half of our Mobileye today. So that was the third buy and half of the second buy. So a small profit on the second buy and a small loss on the third buy. The third sell was the 2 ETFs, sector ETFs that we own, ERX, Energy. You see we had a big shakeout last week on it, kept closing at the top of the range. We did bounce. Let's look at the 5-minute intraday chart on this. You can see that this was the big spike up when the UAE announced that they were cutting their supply to Asia based on what's going on in China. So initially you had the gap down. We didn't significantly break the lows of the gap down, so that led me to hold on to see what happened as the day progressed. We pulled back a little bit, made a higher high here, but then just started bleeding and rolling over into the close. It was negative, and we hit our 0.1% loss on that. hit it early, we bounced, we hit it again, we took it off, so we sold ERX. You can see that's also on the bounce, it failed into the 21-day ERX. You can see we failed on the bounce into the declining 21-day moving average. Anytime the 21 rolls over and you're below it and you're negative in a position, get out. And that's what we did. And then GDX just really didn't act well since we bought it. We bought it on this day when all gold stocks were trying to break out. They followed through on Wednesday before Thanksgiving, inside day Thursday. Sold off today, broke back below the ADMA, and we were negative. We lost about a half of a 0.05% versus overall portfolio. And again, I'm just not going to sit and wait. If the market has a minor change in character, I'm going to take action. So those sales reduced our beta from 0.96 to 0.73, and we'll see where we are tomorrow. Continue to ask those questions that I brought up. And make decisions on the rest of them and see what happens when we get into Wednesday with Powell. So let's go through the focus list now. The top 3 stocks that I'm not in that I would want to be in are AEHR. So if we pull back and this pullback is contained and it's reasonable and we bounce at the 21, I'll be looking to re-enter AEHR after getting shaken out on it about 3 weeks ago. The action since that shakeout day and the fact that it made new highs tell me that it's a leading stock and broke out of a base, acting pretty well, volume patterns positive. Good story with the silicon carbide, and if the market's going to go higher, it will go higher. Second one was ON, same situation, silicon carbide, acted well, bounced off the 21, but reversed today. All semiconductors were weak, held right at the 21. Stochastic rolling over though, so this one's probably going to need more time. Would like to probably see it go sideways if the market wants to cooperate. And then finally, ANET, another one that I got shaken out of on that day that Zuckerberg said that they were cutting spending, but it was bought up consistently. My mistake was really not getting back in right away. Could have rode it higher along the ADMA. Good stocks, when they're trending higher, man, they just ride this ADMA. I pay a lot of attention to that. That's the easiest, most stress-free way to let something run. And then if it rolls over and breaks it, take a little bit off. But it did roll over today and broke below it, so now it's going to need more time, see if it comes back to the 21 and what the overall market's going to do. GFS was one that we bought on the shakeout back here last week, but now it rolled over below the ADMA, still above the 21, so we've got one buy that's positive, one buy that's negative on this. Note the stochastic rolled over, so we're paying a lot of attention to this, and we'll cut it if on continued weakness. Other stocks we're looking at in-house, PSTG, but it broke below the 21 today. So that's a change in character for it. From a negative standpoint, Keys acting pretty well. This is in that electronic scientific measuring group that's acting very well. And this stock really holding up nicely sideways. Good reaction to earnings, really controlled pullback. I don't like the volume on the pullback, but it's still above the ADMA. So anything that's still above the ADMA is outperforming the indexes because they all rolled over below their ADMA today. So always compare to the sector and what the overall market is doing from a relative strength standpoint. SANM, been watching this for a while since its gap up, really not making any progress, but then again, neither is the market after today. Came off of overbought. This may need some more time as the stochastic hooked down there. And again, seeing the common thread breaking below the 8 EMA. CALX, this is another one that gapped up recently on earnings, but couldn't make any progress. Bounced at the 50-day moving average, got back above the 21 last week, but broke below the 21 today. So we're watching it, but we won't be concerned that much with it anymore. Amgen, just pulling back in a controlled manner, but did break below the ADMA and it rolled over now, along with a negative stochastic, still above the 21. Ideally, these leaders will pull back to the 21, they'll hold, the stochastic will reverse higher, the market will hold the 21 and go back higher, and they'll give you lower risk entry points If not, if the market breaks the 21 and they do too, then that's telling you a completely different story. SCHW, this is one that Alex was looking at, has had a pretty nice setup here. You can see the big long cup and handle, tried to break out, couldn't quite do it, broke below the ADMA today. So that's a consistent theme. A lot of stocks, stochastic rolling over, broke the 8, still above the 21. We need more info for the rest of the week and to see what happens with Powell speaking on Wednesday. Apple, this is not a good sign for the market. Stochastic rolling over, sold off. There was multiple reports that the unrest in China is really hitting them as far as the production of their iPhones go and their Foxconn partner over there that makes them. This is not good. Broke the 21, broke the 50. Not good for the indexes, not good for the overall market, and certainly not good for Apple. Tesla looked like it was trying to put in a bottom over the last week when it had some nice volume, above average volume. They're starting to deliver their first semi trucks. It at least is holding the ADMA and showing some relative strength over the past week, but still below the 21. Positive stochastic coming off of oversold for Tesla. So it has that going for it. AXSM, these last two are stocks that gapped up this morning, either on news or earnings that we want to get on our watch list. Big volume, 703% above average volume. Good phase 3 trial results for a drug. Broke out very nicely. But what we've been seeing in these is not a lot of progress, with the exception of that SMCI that I mentioned. Let's take a look at that, since that was basically the leading stock in the market. And look, a little damage done to that. This is how leaders are supposed to act. Didn't even touch the ADMA, continues to ride that ADMA higher, coming into the profit taking area if you're inclined to do that. Volume slightly above average today, but only down 1.5%, basically in line with the indexes being down. That is just a really fantastic action. And PDD, they had earnings. This is a Chinese stock. Very likely there's no chance that I'm going to be buying this, but the volume was there. The price action was there. On the other hand, Biogen had a negative reaction. Another person died in their Alzheimer's trial. So it was down on above average volume, closed right on the 21-day moving average. And that is going to wrap it. As always, like to hear feedback from you. Like I said, good, bad, or indifferent, or just comments on the way we're doing things, something you want to see, something you'd rather not see. But we listen to our clients and our followers. Without you, we don't exist. So you got something to say, speak up. So email don@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. So kind of a concerning day here. Minor change in character, but again, fool me once, shame on you. Fool me twice, shame on me. We'll see if there's further weakness, or an inside day tomorrow would be the best case. See how the overall indicators, the dollar and bonds and the VIX act relative to what's going on in the market. But really, it's quite natural to pause here, fail at the 200-day moving average here in August, fail at the 200-day moving average here in April. If we get another leg down, we'll break below the 21 and we'll end up net short. And if we go lower, we'll ride it lower. So wrapping up Monday, 11/28. This is Don Vandenbord, telling it like it is. Have a great day. Thanks for listening. We appreciate you. Take care, everybody.